Local private sector has slowed down. It dropped from 10.2% in December to 8.5% in January year-on-year. Private sector credit measures year-on-year changes in banks lending to local companies.
South African Reserve Bank figures released today show that companies are borrowing less. The 8.5% was below a trading forecast of a 9.4% rise for last month.
What it reflects, it's just the deterioration in the economic activities in this country. The economy it's under pressure. We've seen rising inflation, we've seen increased interest rates. That with the recent one being the 50 basis point that the Reserve Bank increased by at the beginning of this year.
Total credit extension in January was at 8.5% from 11% year-on-year in December. The rate of growth in South Africa's broad M3 money supply slowed to 10.2% in January from 10.4% year-on-year in December. Money supply reflects the amount of money circulating in the economy. When money supply increases, it typically increases the availability of loans which individuals and businesses use to make purchases. The higher the money supply growth, the higher the growth in available funds. But if money supply growth slows, it can have a negative effect on the economic growth.
Banks are beginning to tighten the belts, and they're no longer, making credit easily accessible to consumers because, understandably, the conditions have changed, and we're facing difficult times. Many consumers are under pressure. We've also seen the consumer confidence, which declined substantially. So reflecting pretty much the tough conditions that the South African economy finds itself under.
Annual loan growth is expected to remain relatively muted this year due to the higher monetary policy stance, high existing levels of indebtedness amongst households and tight lending conditions. If the money supply grows much faster than the economy, then rapid inflation ensues and people lose faith in the value of money. Colin Limawane, SABC News, Johannesburg.